Non-transparent ETFs are getting very real. We have talked about this in the last few shows. Recently, the SEC approved active equity ETF models that would not be required to disclose portfolio holdings on a daily basis. Fidelity, T. Rowe Price, Natixis, among them. This would allow active ETF managers to move from a mutual fund to an ETF wrapper while allowing them to keep their strategies hidden from shareholders. How's hidden? Well, these so-called non-transparent ETFs would move the disclosure of portfolio holdings from a daily to a quarterly event. Doug, active management has seen outflows for years. Will it really do better under an ETF wrapper? I mean, just because if you're a crummy active manager in a mutual fund wrapper, you're still going to be a crummy active manager in an ETF wrapper.
A wrapper is not going to change performance. It can change tax efficiency. It can also change costs. So it's important to remember, a lot of times active management, because it's in an expensive wrapper, maybe it's charging 50 or 60 basis points of performance is eaten up by the cost of the wrapper. We can take that away. We can put it in a more tax efficient vehicle. Now all of a sudden an active manager has a better shot at beating their index.
Now you've got a horse in this race. You're with Natixis, right? You've also filed along with this. Where are you going to be the first to market, or tell us, handicap this? What's going to happen in the next few weeks?
I think the New York Stock Exchange has a horse in every race, and what I mean by that is we're working with every one of the issuers of these models. Yes, in one case we are a co-applicant, but Presidium was the first mover here. We're working with Presidium. We're working on filings for them right now.
Your thoughts on this?
Look, all the structures that have been approved and the ones that are waiting for approval, I think they're going to get it. I think there's going to be a place for them. It's going to come down to the $8 trillion mutual fund industry who hasn't really put these strategies into an ETF wrapper. How do they sell it? How do they distribute it? Who are they marketing to? The market will absorb it. The market makers and liquidity providers that are on this floor and others will be able to support these products.
Who's first,
there'll be enough information.
Who's the first client?
First to market.
Is that going to be really important?
I think so. I think the product will be efficient, like Chris said. Doug has put a ton of work in to make sure that that's why it's taken so long. Do it right, don't do it wrong, right? But you have to have a client somewhere saying, let's move $100 million into this product.
See, I'm going to disagree with the first mover advantage here versus other ETFs, because the reality is in the active world, there are star managers. There are a lot of active shops that have done it right for year after year. They've beaten their index. They've done a great job. Why not offer the structure to them? Does it matter that they're the first to market? I don't think so. I think there's certain managers that people would love to see in an ETF wrapper.
So we all agree that this is good news for overall ETF assets under management. That as a result of this, we will see more assets move into the ETF space. Are we all agreeing on that?
It's a winner for the end investor, because if I love an active manager who's performing well and I can get that same performance. And they're charging you 150 basis points, and now they'll charge you 90 or whatever. What will be the difference? I think that's going to be it. I think easily 50 to 75 basis points comes off of the overall fee, because that's the cost of the fee structure for a fund versus an ETF.
Well, there's another example of collapsing costs for the consumer overall. We've talked a lot about Schwab and Ameritrade and going to 0% commissions. Now you're getting best fund managers out there, those that are able to make this transition, cutting 50 basis points. That's not nothing.
And don't forget, your brokerage platform has now gone zero fee for ETFs. So now you'll be able to trade these ETFs without paying a commission.
So how are people going to make money in the ETF space?
As an issuer of ETFs, you're looking for the best possible product, and what I mean by that is way of investing that makes sense in a portfolio, and then wrap it in the most efficient way, and that's how those managers will continue to make money.
They won't have to sacrifice fees, Bob. Just because a few large managers have been able to cut fees to nearly zero does not mean that a successful active manager, one that you're familiar with, where you're going to put your money in, can't charge 30 or 40 or 50 basis points to manage that fund. If they're earning the alpha and they're earning the business, then
especially if we come out of a passive market. We've just been in a passive market. If we come out of that, the money will flock to active.
Yeah, I mean, it's not going to be a trading vehicle. These are going to be buy and hold investment vehicles in most cases. I don't see them becoming hedge vehicles like SPY. I think these are going to be vehicles that people are comfortable with.
And Doug, you're making an effort to sort of reduce some friction in ETF trading, I should say in redemptions and creations. You're about to launch ETF Hub. Now, this is a platform that you say will make it easier for the creation and redemption process to actually happen. This is a little kind of corner of the ETF market that we don't pay a lot of attention to. But is there friction now and differences in the way people create and redeem ETF
There is. So for somebody who's looking to bring new shares to the market, the ETF exists, but let's say money's flowing in. It's a manual process. You've got to reach out to different parties. You've got to track the assets. You've got to watch them go through the system. The ICE ETF hub that you mentioned, it's starting to go live. It's been live for about the last month. We're starting to bring more issuers onto it. It standardizes the platform. It's open source. It's a way to make a super efficient vehicle of the create redeem. And so now you can trade the ETF, but you can also create new shares of the ETF, and it's simple.
Chris, I wasn't aware that there was inefficiencies, frictions, whatever you think, but it makes some sense to me. But you're a guy who was involved in this. You were a big ETF trader for a long time.
We're 25 years in. We've gone from 0 to $4.5 or $4.3 trillion in assets, and that would indicate there isn't friction. But to Doug's point, there is an operational process. It involves multiple custodial banks and different logins and things like that. So making it more efficient certainly isn't going to hurt the business at all. Especially, it's going to make it easier for newcomers to come to the market as ETF either liquidity providers or operational support kind of providers. Because there's not a whole lot of them out there. There's really only
people think.
Yeah, there's only a handful
leaders.
of major firms that are doing this. So if something like the ICE Hub were to come to market and make it easier for competition, I think that helps everybody.
I would like to see the banks get back involved. 10, 15 big banks get back involved in ETF business. That's good for everybody.
We're going to keep an eye on that. Of course, you'll keep us up to date on what's going on.
I will.
But thank you. Very interesting moments here.